All right. Well, welcome. I'm Scott Oeth, a certified financial planner and uh, financial advisor, and here with Steve Storkan from the Employee Ownership Network, and we're going to be talking about employee stock ownership plans. A really interesting advanced planning strategy, can be super powerful one for business owners looking for an exit and a way to really attract and reward and incent employees, and to do so on a tax favored basis. So we've enjoyed this series. I've talked to a number of people. We've talked about things like employee stock options and executive compensation and family limited partnerships and planning for state residency planning and college tuition strategies, and a lot of great things. And so if you enjoy this, check out my site, scottoeth.com, where we're posting these, and I have a lot of related written blog materials as well. But on this one, I imagine we're going to hopefully do a good job scratching the surface, but there's a lot here that could be that could be talked about. So we're certainly not going to get to all of it. It's a strategy that I think is very interesting, and in the right situation can be a really powerful one. But wanted to bring in Steve because he is truly the expert's expert in this area. And I think one of the fun things for me is Steve and I know each other quite a while. I used to taught for quite a while in the Certified Financial Planner program, taught the retirement planning module, which in that program, about half of it was individuals and how they should plan and plan for funding their own retirement. And the other half was the array of qualified plan structures. And Steve was in that course, but he was a guy I would definitely call on and ask for his comments, because he was working in that retirement plan area and had a lot of hands-on experience. And we've stayed in touch, and that was, what was that, Steve? At least 15 years ago?
Yeah, it might have been 20. I have to look back. Was it 2000? Yeah, I think it was 2006. I got my CFP, so it might have been 2004. Yeah, it's been a while. So
15 to 20 years ago, but it's been fun
yeah.
staying in touch, and you've been very helpful over the years when I've had those thorny or complicated questions. The guy I know I can call and get the right answer, and it's been really fun watching your career progress in this exciting area that you're in. And so, with that, maybe do you want to tell us a bit about your role in the Employee Ownership Network?
Yeah, thanks. I appreciate it, Scott. I appreciate you asking me to do this. I used to do a lot of these kinds of talks before I took the new job 4 years ago, and I like to get back and do them every once in a while when I can. As you said, as I mentioned, I am a certified CFP, practiced in the 401k, individual financial planning, but really focused on retirement plans for corporate America. And ESOPs became a passion of mine in 1996 when I ran into my first ESOP-owned company, and I've been working with them ever since. So I was, had my own small business, worked in the bank channel for a while, and I was the guy that the bankers took around to all their business clients and said, "Hey, this is Steve. He'll tell you more about employee ownership. If you're ever looking to sell your business, make sure you talk to us as a bank. We can loan for you, and this is what an ESOP is." So I've been doing this for a long time, and in 2019, I was approached to help start a nonprofit organization. Employee ownership has been sold to advisors and business owners across the country by other advisors. That's the only sales force there is. There's no real safe place to go. I think people think employee ownership is this product that's too good to be true. And if an advisor is telling me about it, then it must be too good to be true, and they're just trying to get me to be a client. So we started this nonprofit organization called the Employee Ownership Expansion Network in January of 19. Our sole mission is to open state centers for employee ownership across the country. So we want the state centers to be a safe place for advisors, community leaders, and mainly business owners to come to learn about employee ownership. And then if they want to know more, take a deeper dive, we can connect them with the resources that are out there. So the advisors that we have, the white papers, all of the things that we can do to help them understand better what ESOPs are and what other forms of employee ownership are. And if I could just share for a second, Scott, this is our network of state centers that we've created over the last 4 years. There were 7 of them. I can't say I take credit for all of them, but now there are 20 state centers across the country where business owners can come talk to local folks and meet other business owners who've already done this, other ESOP businesses, and learn more about it. And being from Minnesota originally, I have a special place in my heart for the very first state center. I'm sorry, the second state center we opened. North Carolina was first. But anybody that's in Minnesota, if you're looking for a great resource, I'm on the board of directors. You can always contact me. I'm going to leave my information at the end. But the Minnesota Center for Employee Ownership is one of our most active business centers or employee ownership centers, and you can see the website there. So lots of great information there, and thoroughly enjoying this new nonprofit gig. Lots of different things happen in a nonprofit than on the business individual private side, but some good stuff and a little bit of challenge stuff too.
Well, that's great. That's great. Before we dive into the details of how these plans work and what they are, I should throw out the compliance disclosure that, we're talking, this is general information. People listening or watching this should definitely seek their own professional advice. And it's probably going to be a group of professionals, right, Steve? I mean, we're talking about legal issues, tax issues, financial issues, HR employee issues. And so complicated area. This is informational only, seek your own professional advice. And, of course, we'd both be happy to talk about it further, but want to make sure we get that out of there. So, maybe Steve, from a high level, can you explain, what is an employee stock ownership plan? What is an ESOP? How does it work?
ESOPs are, like you said, they have a lot of different moving parts and a lot of different advisors involved. And so sometimes we hear pushback of I didn't do an ESOP, or I'm not interested in doing an ESOP in the transition of my business because it's complex and expensive. We can talk about the expensive piece, but when you think about complex, people make it very complex. It is nothing more than a sale of a business, and all sales of businesses are complex. And so I try to make it as simple as I can. And I'll put it to you this way. I'm going to pull up a slide, and we're going to go back and forth with slides here. I think I don't want to be the presentation, but I think sometimes, you can share things better in words. But it takes me back to my very first retirement plan that I worked on back in 1992. And that was an annually valued profit sharing plan. Before 401k plans came about, companies would share the profits at the end of the year. They would tell their employees, look, we are making a profit sharing contribution of 10% of your wages today, and it's going to go into an account for you for retirement, and someone else is going to invest it for you. You just need to know that we put away 10% of your pay in a profit sharing plan. And then 401k plans came along and made them much more complex. But an ESOP is nothing more than an annually valued profit sharing plan. The difference is that when we say we're putting in a profit sharing contribution for you, we're investing it in company stock of the business in which you work. And so we'll get into a little bit more on how that works, but that really is how it works. At the end of the year, company puts in a contribution, the same percentage for all employees typically, maybe it's 10% of your pay. They turn around and they use that money to pay off a loan that they use to buy the shares from a selling shareholder. I keep those shares in my retirement account. They get valued every year. And when I retire or I quit, I have this retirement plan asset, which is the stock of the company in which I work. Tons of other things that go into it. But at the base of it, it's that profit sharing plan that's invested in company stock. A couple other things you see here. Almost always there is no employee money used to buy in an ESOP. You can have an ESOP that has employee money. You could take a 401k plan and you could offer your employees, hey, we're going to buy the company from the selling shareholder through this ESOP vehicle. We're going to do a one-time window where you could take money from your 401k. And if you want to buy more shares than you would have normally got, you certainly can do that. There'll be lots and lots of securities exchange, SEC rules and things to go through. But typically an ESOP is 100% funded by the employer.
Yeah, I think that's it's really remarkable. So I work with quite a few business owners. That's probably what we're going to focus. The direction we're going to have a fair amount of the conversation today is the advantages if you're a business owner. You're thinking about your company legacy. You're thinking about loyalty. You're thinking about how do you unwind or exit on a tax advantage basis. And there's some really powerful potential advantages to the ESOP here. But in the big picture, I mean, this can be a tremendous benefit for the employees. So their participation, being able to be owners in the company. Steve, I know you've shared in the past some numbers about average balances, the value of the employee plan balances, especially maybe for some demographics that typically have not been able to accumulate as much in 401k plans. The balances are much, much, much higher by this act of setting up and funding that profit sharing plan, essentially with shares of the company stock. and not requiring contributions from them to make this happen. It's all the mechanics are on the business side, right?
Yeah, it's, ESOPs and employee ownership in general, but we're talking about ESOPs today. ESOPs provide benefits both on the employee side and the employer side, or the business owner side. And you touched on almost all of them on the employee side. And I can best sum it up with a real quick story of a company that I worked with in the Twin Cities. I helped them put their ESOP in 2002. 1999, we put the ESOP in, and in 2018, they ended up selling that company to a competitor. And so from 1999 until 2018, these profit sharing contributions were going into the company, into the participants' accounts. I think the average percentage was around 8% contribution. They would buy stock from the selling shareholder who left. In fact, they did it in two tranches. They did it from the main shareholder, and then they did it with two other shareholders. So they ended up becoming 100% ESOP owned. And the great thing about that is the demographics. This is a manufacturing plant. The demographics, the beneficiaries of this were all the people on the shop floor. And that demographic is a diverse demographic. This just happened to be in a community where there were a large amount of Hmong employees, husbands and wives and sons all worked together. It was a great company, and still is. But when they got done, they split among 150 or 200 employees. That company was sold for around $28 million. And those employees split that, and it's all now in their retirement account. And that's just one of thousands of stories that happen. And doesn't mean the company has to sell to get that. You can still be an ESOP and leave and take your shares out. So it's a wealth building for every single person, no matter what your level, color of your skin, the level of education you have. I mean, you're a worker. You put in sweat equity, we're going to help you share in the profits. So that's great. And that's why I'm so passionate about it. I was one of the people that used to be able to write those checks and hand them out. And so to see the smiles on people's faces, or see the statements that they would get every year, say, hey, wow, your account's worth this much. That's why I do this every day.
Right. So we talk about business owner employees, but the business itself, there can be some real benefits too, because you've got employees that are engaged like that, seeing those statements. I mean, truly vested in the company's success. And I know you've talked about loyalty and retention, the ability to attract and keep talent. Looking recently through the pandemic and the tough hiring times many companies had. I think I know I've seen some information about how much better companies with ESOPs have had it in terms of being able to keep a talented workforce at hand.
Yeah, and one thing, I have a presentation. I didn't want this to be a presentation PowerPoint. I wanted to be this a conversation. But I'll let you have. I'll send you that presentation. You can share it with your audience because those charts are in there. But definitely all the things you said: higher productivity, more loyalty, higher wages are paid. Higher benefit levels are paid, and then retention. We saw during COVID, this is a family. The business becomes a family when you're all in it together. Doesn't fit everyone. There are a lot of people that say, you know what, I just want to come to work. This ESOP thing's not for me. I don't need to be part of a family at work. I already have a hard enough time with my own family. I don't need a second one.
One family's enough.
Yeah, exactly. But those that that stick around, when COVID came, they came together and said, look, are we all going to go from 40 hours down to 30 or 35? Are we going to pivot? And there's many stories about, hey, we could, a brewery says, hey, we could make hand sanitizer. Like that was an employee's idea. Or a pizza shop said, why don't we make take-home pizza? They can't come. We can't make the pizza for them. Why don't we, They were leaders in those pivots. Let's make the pizza ingredients and send them home with them. Those are the kinds of things that happen to keep people from being laid off. And so that retention, we've seen studies on ESOPs and worker cooperatives that the retention is staggering, the numbers compared to, ESOP companies compared to regular companies. And then, Scott, you mentioned the business owner. I don't want to forget about the business owner, because I know that's part of your audience, or the main audience. From a business owner standpoint, this is a slide I use. We have this on a video that we created, but when we think about a selling shareholder, a business owner, these aren't all the things they think about. But here's a list of things that we've come across where business owners have said, these are things on my mind when I'm getting ready to sell my business. There's almost 3.1 million business owners over the age of 55 right now. who are going to do something with their business in the near future. That's a lot of employees that are going to be affected by that. And these are the things they're thinking about. Will I receive the highest price? Do I get fair market value? Can I leave a legacy? You can see them all here. Can I sell and retire completely? Do I only want to sell a portion of my business? I'm not quite ready to go, but I'd like to take some money off the table. We've seen a lot of that after COVID. Business owners were affected. All business owners were affected by COVID, either in a negative or a positive way. Whether their business is worth more or they're coming out of the trenches saying, I never want to go through that again. Thank God we survived. I need to take some chips off the table, or I need to take them all off the table. So you can see that employee ownership compared to a strategic buyer or a financial buyer, it ticks a lot of the boxes. And that's not just because I work in this area. This isn't supposed to be a biased slide. This is the truth, that all of these different things, like you can sell a portion of your business. Well, could you sell a portion of your business to a strategic buyer or a financial buyer or a private equity firm? Maybe, not usually. They usually want you to sell, stick around for a year. If they keep you for a year, you're lucky. They promise a year, right? And then 3 months in, they're like, you know what? Yeah, we're back. I think we need to part ways. Here's your last check. So just lots of different things that I think employee ownership can provide, that we've seen, and especially that leave a legacy.
Yeah.
Like you're selling it to your employees who are going to take good care of it. They've gotten to you to where you have gotten to. Your financial wealth has come from their sweat equity and yours, of course, and the risk that you took as a business owner. But now you're leaving it to them, and they're not having to go out and get the financing themselves with 3 managers buying it. All employees are participating.
Yeah, I think, having had many of these types of conversations over the years with business owners, often it starts with, I might want to sell. I'm thinking about selling. It's very much like a market comparable type thing. Well, I think I can get this, and the whole discussion where they're starting from is the price. And I think it's no secret there might be ego or self-esteem wrapped up in that. You want to get it from 7 to 10 with however many zeros behind it. And so they're focused on really that price, and important for sure. You want people to get an attractive price. We try and frame it and say, how does this relate to your personal situation? Your family, your family's goals. Do you have enough now? Can you afford to sell? Are you well into the legacy factor here, where it's more about just optimizing the transaction, and you've accomplished everything you need to, and we're looking to really sharpen the pencil on tax strategy and things along those lines. And so I think we spend a lot of time focusing it back in terms of their personal need and what they really want to do with those dollars. But through those conversations, 2 of the things where you had the checks up there for sure under the ESOP, very often you'll hear a strong passion around the employees who helped build the company, and making sure they're taken care of, making sure there's a strong legacy, helping them participate in enjoying the success of it. That's great. And the tax advantage, everyone loves to hear about a potential tax angle. So it's not always just the top dollar that's getting kicked around because this company sold for a certain amount last year, and I can't sell for less than that.
Yeah, I think if business owners are true to themselves and they have a good advisor like you that is asking those questions, if you get to the real root of it, I don't know very many business owners who don't want to leave a legacy of some sort and take care of their employees. Right. Especially in the realm of the baby boomer business owners who have started these companies in their garage, in their basement. Maybe their grandfather or their father or their grandmother or their mother started these businesses. It means something to them, and they know that there are long-term employees or people who have gotten them there. And so we see that a lot, and they're just worried about, can I get fair value for it? Right. My neighbor sold their business for 7 times earnings, and so that means I can sell it for 7 times earnings. And that's if I take X times Y, that's what this equals. And I think the more you dig in, how much is enough? What are the net proceeds? And so that's the main purpose of what I do every day at EOX, and what the centers do is we just want employee ownership to be at the table. And right now it's not at the table. People don't know about it. And so I hear so many stories of people who have gone through it, and then they tell their story of where they were when they stumbled across employee ownership, whether it was a strategic buyer or private equity or someone. I hear it over and over again. It just didn't feel right. but I didn't have any other option. And then all of a sudden, by the grace of God, employee ownership showed up, and now look at us 2 years later, 8 years later.
Mhm.
I'm so glad that, my CPA told me about it, or I saw an article, or, something that made me stop what I was
Right.
doing. In fact, it just happened 2 days ago for a business owner in Minnesota. He has a letter of intent from a private equity firm and stumbled across it on our website, and now we're working with him. So,
Wow, that's great.
yeah.
Well, what is the process, Steve, for a business to sell to an ESOP, or an ESOP to purchase a business? There's some
So,
mechanics in there, right?
yeah, there's lots of mechanics in it, and it goes, it can go pretty deep and can get confusing, but let me just try to do it in a 4-step process. You've got the shareholders, one or more. They have shares in their company, shares of stock. The ESOP, or the company, we'll just call it the ESOP, but a lot of times it's the company that buys the shares. But the company or the ESOP, we'll call it the ESOP. The ESOP buys the shares, so they go out and they get a loan. The company goes and gets a loan from a bank, based on the future profitability of the company. They buy the shares from the shareholder, and those shares go up on a shelf. And there's typically 2 loans. We'll get into that in a second, but the simple concept is those shares, as those loan payments are made, the shares are given to the employees. And again, we go back to the way it works. The employees have cash in their account from that annual profit sharing contribution. It pays the loan, and they get shares. So if I have a 10-year loan, over 10 years, I allocate the entire value of my company. Most loans are much longer than that, not the bank loan, but the internal loan. So it's just a concept of shares being bought by the ESOP and then being allocated on an annual basis over the life of that loan.
So it's the future profit sharing contributions that the company is going to be making to this plan on behalf of the employees. Those dollars are buying the shares.
Correct. Yep. And those dollars are turned around. You give money to the employees, they turn around and give it right back to you so you can pay your loan payment. And in exchange for giving you that money back immediately, you give them shares equal to the amount of money that they gave you.
Mm-hmm.
And then those shares accumulate. They stay in that holding account, but as they were released, they get allocated to those participants. This is what an ESOP, this is what it looks like when an ESOP buys a company. You might have 3 shareholders, and if you transfer 100% of ownership to the ESOP on the day of closing, there becomes one owner, and it is the ESOP trust. So it's a retirement plan. You have to create a retirement plan qualified by the IRS. You have to follow all the rules. That's a whole entire hour-long, interview on how that works. But you create this retirement plan, and that is now the retirement plan now holds all of the shares of the company. They haven't been allocated to the participants, but the participants are beneficiaries or beneficial owners of that trust, and those shares are allocated. You don't have to sell 100% of the company. In a lot of cases, when you have 3 shareholders like this, you might get to what it shows on the screen. One shareholder is older than the rest of them and on his or her way out. And so we buy 100% of that person's shares. And so now we might have a shareholder 1 that owns 30%, shareholder 2 owns 20% or 19%, and the ESOP owns 51%. You could do the same thing if you were just 1 shareholder. We have many business owners who sell 49% of their company to their employees, dip their toe into to see if this is the right way. If they decide it's not right for them, they can certainly sell the entire company later on. The employees would share in 49% of the profits, and the remaining owner would have the 51% or whatever percent they sold. I know someone that's done 4 different sales, started with 10%, sold another 20. So it's very, very flexible in how you can sell to the company. But I think the most important thing to understand is that the ESOP trust, which is a qualified retirement plan, now owns the company.
Yeah. And it is qualified retirement plan. People are very familiar. Most business owners, most employees are familiar with the 401k plan. This is different in that 401k plan. We're typically thinking of employees deferring salary. Now you can have business contributions coming in the form of profit sharing or matching, but the employees are typically needing to really elect to defer their income into the 401k plan, and they can choose a variety of investments. Here in this qualified retirement plan, company's making the contribution on behalf of the employee, and it's just buying the company stock. Except was it age 55, Steve? You can allow for diversification to help protect employees from the risk of that concentrated position.
Yeah, the IRS says, these balances can get to be very large, which is great. All 100% employee contributions from your employer. But having all your eggs in one basket may not be the best thing. And so when you hit 55, there's some special rules. If you've been there for 10 years or more, you can start to request from the company, and they're required to buy from you some of those shares. And then there's all sorts of different ways that you can do with that money. But typically what a company will do is say, okay, you've met those rules. You want to sell back some shares. Here's the cash. Go ahead and move it over to your 401k, put it in your IRA, do something with it. You want to go buy a boat with it, go buy a boat with it. But each plan is different. But yeah, you're right. It's the majority of ESOPs are 100% employer stock with nothing else in it, maybe a little bit of cash hanging out, but no other investments.
Right. Right. Well, we talked about price, we talked about the advantages, but I mean, so if an ESOP is going to buy a company, a business owner selling to the ESOP, how is that price determined, and how does it compare to other mechanisms or other buyers out in the market?
So ESOP as a buyer is regulated by the Department of Labor and Internal Revenue Code, and it's based off of the concept of fair market value, a willing seller, willing buyer. And that's the highest price or the only price that a ESOP can pay. It could pay less than fair market value, but most selling shareholders don't. I've had a couple who say, no, fair market value is way more than I thought I was going to get. But that doesn't happen very often. So it's fair market value. And that's where the concept of a myth, I think, about ESOPs is, I'm not going to get the value that I could. I'm not going to get the highest value by selling to an ESOP. And that is true to a point. It's true in that an ESOP can't be like a strategic buyer can be, which is, if I buy your company, there are going to be some synergies in our two companies, and I can now get rid of the accounts payable department. I can now streamline this, and we don't have to we don't have to ship from New York all the way to California. We now have another plant in between. Right. So I can pay a higher amount because of those synergies. An ESOP can't do that. An ESOP says willing buyer, willing seller, no, nothing more than what is the value of the company based on the valuation process. And so that value has to be set by an independent third party. The ESOP participants or the employees are represented in this buy and sell transaction by a trustee, so a fiduciary that puts their name and signature on the line that says everything about this transaction is on the up and up, and part of that is the valuation that we came up with. So there's some back and forth. The business owner is on one side of the table, the trustees on the other side, and they go back and forth on what the fair market value is. The interesting part about the way this works, the trustee is the one that sets the price. The business owner doesn't say, well, this is what I want for my business. The trustee does all of their work with their independent appraiser and says, this is what the price is, and here are the terms with, any sort of earn out on the back end or warrants or stock appreciation rights, things like that. This is what we're presenting. And then they go back and forth. So it's a little bit different than another third party, but it's the concept of fair market value.
Where does the trustee come from? How are they hired or selected?
Trustees are hired by the company to represent their employees. Typically, they are part of a bank trust company. Okay. Or we've seen in the recent past, the last 10 years, we've seen individuals come forward that have been part of, they know a lot about employee ownership. They've been on other sides, or maybe they work for a bank trust company. They've created individual trustees who are taking the fiduciary responsibility, but they really do sign down the dotted line that we are taking the fiduciary responsibility. And if things go wrong, we're on the hook for that. So it is it's becoming more and more expensive to hire a trustee because the Department of Labor. The problem is we have a definition of fair market value from 1986, and it has never been updated. And so here we have these people signing on the dotted line using a regulation, and it's not even a regulation. I think it's a temporary regulation from 1986. So, but yeah, it's typically you hire an independent trustee.
When you're showing the boxes and the arrows and outlining the process, you talked about a loan. I know I've heard the term leveraged ESOP, but not all of them are, right? I mean, what's the difference there between leveraged or bank financed versus not?
So every ESOP is leveraged at the beginning.
Okay.
Back in the early days of ESOPs, I shouldn't say every, I've not seen a non-leveraged ESOP in a really long time,
Okay.
if ever. But I've taken over ESOPs where they said, my grandfather, I'm thinking of one in southern Minnesota. My grandfather started an ESOP in 1987 when it first came out, and he basically put the shares into the ESOP. He said, I'm going to reward my employees. I'm going to take 20% of the company and put it in the ESOP,
Okay.
and we're going to allocate it. So leverage just means that there's a loan. So almost every ESOP nowadays is a leveraged ESOP while that loan is being in place. And this is where it gets very confusing. And I'll share my screen again. Try to stay out of the weeds here, but what happens in a more detailed, instead of the basic ESOP, what happens is you have a lender who makes a loan to the company to buy those shares. So there's this loan on the outside, and if the bank was going to finance 100% of it, that lender would probably only finance that for 6 or 7 years. So let's just say we have a bank that's going to lend to the company to buy the shares. They need to get a loan for 6 or 7 years to pay off that lender. But at the same time, the company turns around and has a loan between the company and the ESOP that's much longer. We don't want to take a $30 million company or $10 million company and allocate it over the 6 years when that bank loan is. We want a second loan that's maybe 20 or 30 years, so we can continue to pay those shares back at a lower rate, make it a longer term retirement benefit. So we have these two loans that are happening. And at the same time, you've got the shareholder who has the stock going, like we said, the shareholder gives the stock in exchange for those dollars. So this is where it becomes very confusing. I try not to spend a lot of time here, but this is the concept of a leveraged loans, is there are loans out there happening. The one thing I will say about the leveraged loans, and I don't put it on here to make it even more confusing, is that typically in an ESOP transaction, a bank will only loan between 30 and 60%, and those are arbitrary numbers. It depends on every single deal, but let's just say the bank is willing to loan 40% to a company based on its future profitability. The selling shareholder, the business owner, has to carry the other 60% as a subordinate loan, unless they find someone else to step, maybe they find another bank or a mezzanine lender with a higher interest rate. But there's typically not any ESOP deal where one lender is is on the hook for all of those dollars, because it's it's an unsecured loan. Basically, it's based on the future profitability of the company.
Yeah, that's what I was going to ask. I mean, is this widely done amongst banks, or are there certain banks or lenders that really specialize in ESOPs, and business owners are typically going to them because they've done this before, they understand the transaction, they feel comfortable assessing the risk? Where do you get the money?
It is not, unfortunately, it is not common. And it's because of the structure. It's a different type of structure. There's typically not a personal guarantee on the loan. If you're a business owner and you're leaving the business, you're not going to sign put a personal guarantee on it. And the management team's probably not going to do that. So definitely specialized lenders. When you look at, for example, when you look at the Minnesota Centers website, under their Talk to a Professional, you'll see, 3 or 4 banks in Minnesota that are the key lenders. Some of the bigger ones are starting to get in there, but it's typically a community, it's old style community bank,
right?
That kind of they have to follow. Every bank has to follow the rules, but they think a little bit outside the box. Like, no, this is one of our clients.
Yeah,
they've been a long-term client. We know their business. That's how they kind of start with the lending, and then they see, wait, these ESOP loans don't default, right? Like if the trustee is going to put their signature on this, that this is a good deal, and they think the profitability of the company can continue, unless something drastic happens. If they think the profitability of this can continue, and they've done it to the point where they can pay back the loans, very rarely do we see a default on these. So it takes 1 or 2 of those loans, and next thing you know, I have this community bank that's really interested in ESOP lending, where some of the bigger banks, they just are way too structured. So it definitely is a specialized type of lending. Wish I could get more. We continue to try to recruit more and to get them to understand. I've been in some of the underwriting meetings, being a former in the bank channels. I've been in a few banks where I've been in the underwriting, and I knew what a great deal it was. And to listen to the conversation with the loan committee, and here, you had basically 5 minutes to present your case, and then it was either yes or no. So I've seen the underbelly
Yeah.
of lending, and it's not pretty sometimes.
Yeah, well, my first steps in this career were under the umbrella of banks, both large, like regional type bank and then community bank, and being involved in lending and a branch manager, and yes, sitting in the lending discussions and understanding, same thing we see like in the insurance world or different areas like that. Some companies will see that as an area of opportunity and decide we will get really good at this and focus on it. And other ones say, we don't quite understand that. It's out of the box, not worth our time. We're not going to touch it. So, okay. Well, hey,
And unfortunately, for the ESOP world or employee ownership world, that's what happens across the board with even other industries. You think of, I was just at the Minnesota CPA conference, tax conference for Minnesota CPAs, and I don't mean to pick on CPAs for a while, but historically,
Yeah.
historically CPAs have said, and I don't know where this comes from. I'm just going to my own Steve Storkan opinion is, it's complex. I don't understand it. And because I don't understand it, I'm not going to recommend it. I'm not going to pretend like I understand it and say, this is why, but I just don't go down that path because I don't see it as an opportunity because I don't understand it. And when CPAs are one of the most trusted advisors, financial planners could be the same way. We're really trying to educate them of, look, it's not right for everybody, but it should be on the table. So
Right.
we do it with lenders, CPAs, financial planners, and I just hope we can get more to understand that it is a viable option.
Yeah, and that is frustrating. These types of strategies don't fit every case. They might only fit 1 out of 10 or 1 out of 100, but it's not a good enough answer to say it sounds complicated. Let's not talk about that. It's worth exploring and worth taking a look at. So, so Steve, let's get to some of the real juicy, fun stuff. What about the tax advantages here? What are we talking about? We've mentioned that, we've alluded to it, but how does it work if you're a business owner? What type of tax advantages are at hand?
Yeah, we've led with the tax advantages for many years, and I'm now on the nonprofit side, so I tend to lead more with the ooey gooey stuff, leave a legacy, reward employees, which
Yeah,
is
you
all
become a
really good.
softie. Yeah.
Yeah, I'm a softie. Yeah, but yes, definitely taxes. So there's tax
Help us
advantages.
capitalist out. What are the tax advantages?
So tax advantages for business owners and tax advantages definitely for the business itself. So let's start with tax advantages for the business owner. If you are a C corporation and you sell more than 30% or 30% or more of your company to an ESOP, you are eligible for what's called Section 1042 rollover. It's very similar to the 1031. I think it's 1031, right, Scott? Investment property
1035, that whole series.
Yep. 1031, 1035 exchange. And what it says is if you're willing to sell 30% or more company to an ESOP, you do not have to recognize the capital gains involved in that sale if you take for whatever percentage of the proceeds that you take and reinvest in qualified replacement property or QRP. And in this case, QRP is individual stocks of US-based companies. We still haven't even, that's a rule from 87 as well, I think, and it still hasn't been updated to understand that there are mutual funds, and you can't even do it in a mutual fund. So it goes into, individual stocks or bonds, and there are some, really complicated tax strategies where you can invest in something and get your money back out through leverage. There's 1042 specialists that do a great job where you can take advantage of this exchange, but yet still have access to your capital. But at its core, a C corporation owner can defer. If you sell 100% of your company, you can defer 100% of the gain if you take all that money and don't use it. The second part of that is if you happen to have a business where you don't need the proceeds, you've got enough wealth on the other side, in other vehicles. If you die with the QRP, your children get a step up in basis. And so you can really, through an ESOP, sell, if you're a C Corp, you can sell tax-free, where you never pay tax on that gain. So
Which
lots of different uses,
really remarkable. I mean, you have a company worth 10 million, 50 million, $100 million, sell, help the employees, and diversify that wealth. And like you say, maybe be able to borrow off of it for spending needs, live off dividends, live off of interest income, selectively sell, in small slices as you need income. And then, as the tax law stands today, benefit from the step up in basis and essentially wash out all the gain really, really remarkable.
Yeah, as I said, the step up in basis upon death, I probably made a face because being in the nonprofit for 4 years, I'm not as plugged in, but that never did get changed like it was going to, right? That we still have step up in basis in all cases for capital gains. That was only a proposal, right? That never went through.
Still have the step up in basis.
Okay, good. Because ESOPs follow all capital gains step up in basis. I was like, oh God, did I say something? Again, back to legal tax advice. Check with your attorney, right?
That's right. Well, and of course, I'm sure you'd love the idea too that those shares might continue to appreciate, and those would be ideal opportunities for charitable gifting. We did a whole series on charitable gifting and philanthropy, and those can be wonderful. Much better in many cases than opening up the checkbook. Use those shares to fund your donor advised fund or a charitable trust or a family foundation. And yeah, like I said, we recently did a whole series on charitable giving techniques, but that is the type of property that is ideal, looking to the balance sheet to facilitate your gifting and philanthropy rather than the checkbook.
Right. And it's the unfortunate part of 1042 is that it's only available to C corporations. And so if you are an S corporation, I'll get into the benefits for ESOPs for S corporations in a second. You really have to weigh the benefits of future benefits for an S corp versus my own individual benefits as an owner. We do see many business owners do that analysis to say, I am an S corporation and I really want to take advantage of this capital gain. So can you tell me what it looks like if I was to convert tomorrow from an S corporation to a C corporation? And all of it goes into that, because you certainly can do that. You can switch your company from an S to a C, follow all of the rules that I don't know and what goes into that. But then as a C corporation, you can then sell it. There's some waiting periods there that I think you have to have. But definitely, there's some strategies there. So that's the selling shareholder tax advantages.
But Steve, if the S corp is owned by the ESOP, S corp is a flow through tax entity. The ESOP is a qualified retirement plan, tax exempt. The dividends, the dollars that would normally be flowing through as taxable income to the owner are contained within the ESOP, right?
Yeah, so that's where I was going with this next that I'll put this up on the screen and try to do diagrams rather than explain it. I'm sure most of your audience knows the difference between a C corp and S corp, but just as a real basic reminder, if you have a company that's a C corporation, the profits flow into the C corporation, and then at the corporate level, paying taxes, federal taxes at the corporate level, or they're paid by the corporation. And an S corporation, if Scott and I owned a company together, and Scott owns 60% and I own 40%, the profits would flow through to the S corp, and the S corp would flow 60% of the profits to Scott's personal tax return, and he would flow 40% of those profits to my corporate tax return, which would add to our income to pay our federal taxes. So if you take one of us out of that share, or you take us both out of that, and we sell that company to an ESOP, the profits now flow to the S corporation. The S corporation sends those profits, or attributes those profits to the ESOP, which is the sole shareholder. And because we don't have to pay, because the ESOP is a tax deferred entity, there are no federal taxes for a 100% S corp ESOP. So if Scott was to sell his shares and now we're a 60% ESOP, 60% of our profits would not be taxable. This is the most widely used and the greatest benefit from an ESOP when you get outside of the non-capitalist side, as Scott would say, the ooey gooey side. This is how most ESOPs are working right now. And can you imagine what you can do if you no longer have to do things with the profits? You no longer have to manage your business for taxes. You don't have to send profits out the door. You don't have to buy equipment. You don't have to, necessarily pay higher bonuses than you might do, or, all of the things that we do as business owners to try to lower our profitability. You now have an S corporation that can retain those and do acquisitions, expansions. And because of that, we have seen S corp ESOPs, and this rule came into play, I believe, in 1996 or 1998. We have seen S corp ESOPs just do amazing things. They are getting acquired left and right now. We are losing more ESOPs on an annual basis than we are gaining. and we're gaining more than we ever have. We're putting in more ESOPs than we ever have, but we're losing more on a net basis because they are such they're target for acquisitions because they are amazing companies.
I see.
They've
That's
done
how
amazing things. Yeah,
that's how you're losing them. They're being purchased, not that they're dissolving the ESOP and saying this was a terrible idea. It's that the
right.
company is thriving, and so it's purchased.
Yep.
And
And
so
that was
yeah,
the story of the manufacturing firm I was telling you. So they went,
right.
they were an S Corp ESOP. They went 18 years or so running an amazing business. One of their competitors came in and said, "We can't compete with you anymore.
Yeah,
Let's join forces. You're I don't know if they said this, but I can only imagine the conversations behind the scenes. They're
right.
killing us. What are they doing there? Well, they got a company that's run by the employees. They're all in. Their productivity is amazing. Who else would we want to acquire? We want to acquire a company like that." And so that's what's happening across the board. And it's a great thing for employee owners. They're getting some nice size checks. It's a bad thing for employee ownership that we're losing more than we're gaining. But you know what? That could have been owned by one business owner, right? It could have still been owned by the guy that sold it in that manufacturing firm 18 years later, and he could have reaped all the rewards instead of that 26 million going to the employees. So
Yeah.
it is a good thing, but a little disappointing.
And that is what happens, the 26 million. So the acquiring company writes a check, that check goes into the ESOP, all the employees get cash then in that plan, and the shares of the company go to the acquirer. So
Yep. And that 26 million, I think of that 26 million, roughly 22 or 23 million transferred to their 401k plan.
mhm.
Some people took some, they had the ability to take cash out if they wanted to.
Yeah.
But you also teach employees financial literacy when you have an ESOP as well. And so
Yeah.
we did a really good job in that one of teaching them, look, if you want to go to Disneyland, take your kids to, on a trip, you can take $10,000 out of this windfall, put the other, 600,000 of it in your 401k plan.
Right.
So
Yeah. Well, so big potential win-win-win, benefit business owner, benefit employees, benefit the business itself, let that thrive. A lot of interesting angles in terms of pricing and tax advantages, but it's a great fit for some companies. As we talked about, it's not a fit for every company. So who is a good candidate for an ESOP? I mean, are there indicators to say this is a great opportunity, or this type of company, interesting idea, but it's probably just not the right fit?
the number one thing to think about is the business has to have a track record of profitability and the future has to look bright. An ESOP is not going to take a bad company and make it good. It's not going to take a company that can barely make profits and make it better. In fact, it'll hurt because you now have this loan to pay off the selling shareholder. So you have to have the profits in place and the future profits to pay down that debt as you go. So number one is profitability. Number two, people ask, well, how many employees do we have to have? And everybody has a different number. My number is somewhere around 20 or 25 is kind of the minimum that you need to have. But I've seen them with less. But what it comes down to is how much money do I have to put in to make that loan payment every year? And if I only have 5 employees and it's a $10 million company, it's a pretty big profit sharing contribution I have to put in, and it will be above the IRS limits. And so it comes down to more of what's the company worth versus payroll. I can have a small company of 15 people that's not worth a whole lot.
Yeah.
And we could probably do an ESOP. I can't have a 15-person company that's worth 80 million and try to pay that off. So it's less about the participant count and more about that relationship between value and the number of employees. But if someone were to put a gun to my head, it's 20 to 25 employees, and it's a company that has somewhere around $1.5 million in net profit, net earnings, EBITDA. Somewhere around there is the sweet spot of what we're looking for. Probably want to have one that has a low turnover, and I can throw this screen up. I can throw this up on the screen too, just for people to see. Probably want to have low employee turnover. And just as importantly, I probably should move this to the top underneath profitability, has to have a strong management succession plan in place. If a trustee is going to be representing the employees on the side during the sale transaction, they're going to want to know that if Scott and I own a business together, when we leave, we're not going to take the business with us. We don't have every relationship. People aren't with us because just us. We need to have a strong management team in place. That's almost as important as profitability from a strong ESOP candidate.
Mhm. That's great. Any particular industries where you see the ESOP more common than not?
Manufacturing,
Mhm.
government contractors, construction, architectural and engineering firms, believe it or not, have become the fastest growing ESOP sector as far as I'm concerned. I don't have any data to back that up. I want to just in my
That's what
experience.
you're seeing. Yeah.
And the reason that happens is, like I said, a lot of people stumble across ESOPs. And when you have a community like that, they hear about an engineering firm that's done it. It just starts to spread. It happened in Fargo during my time working for a bank that was headquartered in Grand Forks. The city of Fargo now ranks, God, what was it? It was top 5 for the number of ESOPs per capita. And that just happened recently. And it was simply the fact that there's a lot of business owners who have CEO peer groups who heard that so-and-so did an ESOP. And next thing you know, it's going to, so it's happening in the architectural and engineering area as well. But yeah, it can work in any industry. The lower the employee turnover, the better. ESOPs are hard to run. They are complex. There's a lot that goes into them. And if you're having to buy shares as people leave and you've got a 60% turnover, that's a little difficult. You're writing a lot of checks and doing a lot of administration.
Yeah.
So yeah, those are kind of the industries I'm thinking of.
Maybe going back a minute, you talked about kind of the magic minimum number, and this is a bit complex, but because the ESOP is a qualified retirement plan, it's a profit sharing plan, there are tax law limits in terms of the dollar amount to the contribution that can be made for each participant on behalf of the employees. So that's where that ceiling is hit, where you need enough people so that those contributions, you can stay underneath that limit, and that dollar amount is enough to pay for the shares, right? Or pay for the loan. Yeah,
exactly. And then the other part of that beyond the IRS limits is what's a reasonable benefit, right? We went from having a 401k plan with a 4% match, and now I'm giving you a contribution, even if it's underneath the limits. Is it fair for the company to be providing a benefit of 18-22% of your pay on top of what you're already getting in other ways? So while it may work, is that a sustainable benefit level?
Yep.
So all of that goes into what they call a feasibility study. When you first start thinking about an ESOP and you engage a team, they're going to do an ESOP feasibility study and just say, look, the value that we're seeing is probably too high for your demographics. You need to grow your employee base if you're going to do this, or it's perfect. It's a sweet spot, right?
Yeah. So along those lines, you mentioned before, people have the idea that ESOPs are expensive. There is complexity there in managing. I mean, what are your thoughts on cost and complexity and maintaining and operating this plan over time?
So I just pulled up a slide that talks about the ESOP team, and you've already alluded to this a little bit. You need an attorney on both sides. You need an independent appraisal company. Your CPA is going to be involved. They'll have new work. You have to hire a third-party administrator that's going to do the work on an annual basis. So that's what I used to do for a living, is to determine how many shares are going to get allocated, who's going to allocate them, make all the compliance testing work, all the things that go into a retirement plan, running the retirement plan. That trustee, both on the transaction and then usually going forward, you're going to want a trustee to be there to represent the employees. And then, the lenders in there. Here's the number where if I throw a number out, I'm going to get phone calls from 3 people that say your number was too high, your number was too low. But I throw it out there anyway. Somewhere between 150 and 500,000. But I think the normal number that I quote is 150 to 200,000 is a common range of what that initial ESOP transaction is going to cost. And that number scares people, and they say, "Oh my God, that's a huge number. ESOPs are expensive." Depending on the size of your company, that definitely could be true. But if you think about what an investment banker is going to charge you as a commission to market your business, bring it to market, help you in the sales process, unfortunately for ESOPs, they don't have you write a check to your investment banker. This 150 to 200,000, these are checks being written to this entire team along the way. Each one of them gets a different part of that. And it hurts to write those checks. Whereas in an investment banking side or another type of sale, it's net proceeds, right? Same thing on a real estate transaction. I give my real estate best friend, one of my great friends who's a real estate agent, I keep telling him, if I had to write a check every time you sold one of my houses, I don't know if you earned that check, right? we can have that conversation, but instead they take a commission. And it's just net proceeds. It doesn't hurt as much. So there's some debate there on whether or not ESOPs are more expensive. In the end, I don't think they are. I think that percentage, if you look at the commission an investment banker is going to charge, I think you're going to actually find that selling to an ESOP is less expensive.
Right.
There are costs going forward, though. Definitely complex going forward. You have to have a third-party administrator, trustee. Those can cost anywhere between, the total all in on it to run a retirement plan could be, $40,000-$50,000, depending on how many employees you have
Mhm.
on an annual basis. So lots of considerations because it is a retirement plan.
So it might feel more like you're being nickel and dimed in a big way, a more salient fee as opposed to a less visible one with the sale transaction. And I guess, the other thing, oftentimes in these types of scenarios, you look at and say, especially if maybe the tax angle is a driving factor here, and you say, wow, I'm going to sell a business that's millions and millions of dollars and be able to do the 1042 qualified replacement securities, not pay tax now, maybe never pay tax or distribute it over a long period of time as you leak money out of there. Comparing that tax cost to the transaction cost, it might look like a huge win. Right?
Exactly. Net proceeds. I think so many times business owners go into a sales transaction not having been told the definition of net proceeds.
Right.
And there's lots of different ways for net proceeds. Your business is worth X, but what are all the things that come off of it? Whether it be an ESOP or whether it be a straight sale, what are things that you don't get to keep? Because,
Right.
and I'm not involved in exit planning enough to know, but, do you have to pay back? Is there debt to be paid back? Is there, I don't know if it's accounts receivable pay. I mean, all of the things that come off of those proceeds, we have to look at net proceeds, and taxes are included in that. And then you throw taxes on there as well. So yeah, I think it just needs to be looked at, and a good advisor, a good exit planner, a financial planner will help you through all of those steps.
Mm-hmm. All right. This has been great. Maybe one last question. I know, Steve, you've talked in the past, you've mentioned other forms of employee ownership. The ESOP's not the only mechanism, right? There's some other things other developments you're working on?
Yeah. So, just really, really quickly, there are other forms of employee ownership that we promote that we won't get into today. One is a worker cooperative, and one is an employee ownership trust. I'll include this in what you can send out to your clients if you want. Let's focus on worker cooperatives. Worker cooperatives are really for those smaller businesses. They require a very small buy-in. So the employees get together. Let's say one of the worker co-ops I saw recently was a pizza shop that I mentioned. They had 2 locations, 15 employees. 10 of the 15 employees said they wanted to be owners. So they all put in, I think, $1,000. They had $15,000. They each bought into the company. They each got 1 share. And when they leave, they get their $1,000 back. There's no new shares. There's no retirement plan buildup. And now they are all they're share owners, one share, 1 vote. They collectively or democratically run the business. Some of them are on the board, some of them are on committees, but it's kind of this all in together, like ESOPs can be, but much more of a democratic workplace, smaller businesses. But the business owner, the transaction with the lending and how we get financing, it's very similar to an ESOP. So this is an exit option for a small business. It's just a little bit different because the employees have a lot more work to do. It's not, the management team stays in place, but there's a lot more democracy here. And I have to go get a loan for $1,000 or $5,000 or whatever it requires to get in. So there is another option for employees on a smaller business that does work. And then there's something called an employee ownership trust coming over from the UK, very popular in the UK. It's really nothing more than a trust, a perpetual trust. And there isn't equity involved. The employees just simply share in the profits. And so you create this trust just like you would for your kids. The trust tells you exactly how the business is going to be run. We're going to do this much in profit sharing every year. We're going to do this much in retirement. You need to run the business going forward. When I sell it to you and put it in this trust, you as the trustees need to run this business the way I'm saying as I leave for the benefit of the employees. So it's not equity, but it's the only form of employee ownership in the UK, and there are a lot of employee ownership trusts in the UK, and it's just slowly coming over to the United States because it's not a regulated retirement plan. I mean, if that's where the costs all come in, because it's a regulated retirement plan in an ESOPs.
Yeah, very interesting development. So some nice options to consider for businesses.
Yeah, for sure.
That level with the big upfront cost and all that. So. Well, hey, Steve, I really appreciate it. This has been fantastic. Great catching up with you. I always appreciate your insight, learn something new every time we talk. And so this has been fantastic. I encourage people watching or listening, contact Steve if you have questions. I'm always happy to talk and field these types of big picture questions. And in this series, we are posting these, like I say, to my blog, scottoeth.com. So we're getting a pretty nice library of these interesting advanced planning type topics that don't get as much attention as they should. And like we said, they don't work all the time, but when it's the right fit, it can be a really nice solution. So thank you,
Thanks
Steve.
for having me, Scott. I really appreciate it.
All right, take care.
Thanks.